Hello, everybody. Welcome to another episode of the Daily Dose. Today is Monday, February 6th. We did have markets falling today. The S&P 500 was down 0.61%. This is following a huge rally we've had since the beginning of the year, basically, and then last week a less than optimal earnings week, especially from companies like Apple, Amazon, Alphabet, all missing on their earnings reports. Now, this is kind of to be expected because we're now really going to start feeling those interest rate increases that we had a few months ago, where we had like four back-to-back 75 basis point rate hikes. So the earnings are going to lag on that. You're not going to see that played out in earnings numbers for companies right away. That's going to take several quarters to play out, and we're starting to see the beginning of that. So I do expect for the next few quarters maybe to have some weaker than usual earnings until the Fed kind of switches their direction a little bit, but they've made it pretty clear that they want to stay hawkish until inflation is clearly going back to 2%, and they don't know that for sure yet. But they did kind of make it easier for themselves to pivot if they needed to. They said that they're going to be watching the data now and basing their future decisions off of that instead of just blindly hiking rates. And I do think that that's a good decision. So as far as what I'm looking for technically on the S&P 500, obviously right now we're still in this uptrend. We did cool off a little bit. We're kind of finding support at the 4100 level. Right now, the S&P closed at 4111.08, so we are staying above that 4100 level. We kind of breached below it today and then came back up, bought back up in there. So right now, we're kind of in this zone between 4100 and 4200. Obviously, there's big support at this zone as we've had some tops being made at this level previously during the bear market. I did say that I would believe that the bear market would be over when we broke through the trend line and the 200-day moving average. Both of those things have happened. I would be surprised at this point if we go back into this channel just because of the amount of time and the strength which we've broken through it. Now, that doesn't mean it's impossible for us to get another low. We could definitely get another new low, but in my opinion, that's going to be a lot less likely now. Which may be against what a lot of people think, but that's just how I'm thinking right now. Again, not financial advice. Don't make any investment decision based off of that. Always do your own research, but you know that's what I'm looking at. That's what I come on here to talk about. So, yeah, I do think it's a lot less likely now that we see a new low in the market than it was before we had broken out of this trend line and gotten back above the 200-day moving average, just from a technical standpoint, because I once had a professor in college, and he was telling us about technical analysis, and we were having a discussion about whether technical analysis really works, or is it just kind of like a crowd mindset where all investors, big and small investors, we can all see these levels, and so we make decisions based off of them. Is it really working technically, or is it just a psychology of investors kind of situation? We were talking through this dilemma in class one day, and he was talking about how he had this conversation with one of his mentors many years ago. And he said that his mentor told him that he doesn't care. It doesn't matter why the market does what it does as long as you recognize that it's doing the thing. So whether technical analysis really works or it's just a big psychology trick that we all kind of see the same levels and so we make decisions based off of the price coming to those levels, we shouldn't care. We should look at the levels and be prepared for what's to come based off of them regardless, and not look too much into how it works or why it works, because we can see over the course of many days, months, years that it does work. Technical analysis can be a very useful tool in investments. So I don't know why I brought that up just now, but it was just something that popped into my mind. Maybe it'll be helpful for you. But let's take a look at Bitcoin. So Bitcoin's kind of been consolidating since this big run up. We're kind of holding steady above the 20,000, but really even the 22,000 we've held above since we broke back above that. You could even draw a little line of support here, because look at, we've got this resistance turning into support now around the 22.4 even. Right now we're at the 22.985. I've been looking at Bitcoin kind of like an ultra levered stock market at this point. Not from an investment thesis standpoint, but just from a price action. What it's kind of doing recently in this market is it's kind of making its moves based off what the stock market is doing and just making a bigger move. So, again, this also broke through a big downtrend we had been in for quite some time on Bitcoin. And so, I would say that the likelihood of a new low is now much, much less likely than it was before. I'll go ahead and be the first to say that I definitely could be wrong about this 12,000 to 9,000 call. I'd been looking at that for a long, long time. And there's a good possibility we don't get there. But it's definitely still possible. There's a lot of euphoria and greed in the markets right now, and they could definitely switch back to the downside. Obviously, there's a lot of tensions with China and some global fears, but over the long term, I don't think that'll play into Bitcoin price or stock market prices. I think a bigger headwind that could possibly be coming in the future is either the resurgence of inflation, or on the flip side, a big surge of deflation. And basically what would happen then is the Fed would need to pivot quickly, which they would probably ease too much. Once again, that's kind of what the Fed does. They ease and they tighten too much, and we get these big volatile swings in the markets and our economy. And that could cause inflation on the back end as well. So I think the Fed messing something up is more of a worry for me than any sort of like global or political thing at this point. And that'd be really what I'm looking to. I mean, these markets are just so dependent on the Fed at this point. That it sucks a little bit, but you can't ignore it. So, yeah, that's what I'm looking at. Obviously, people are going to say that the stock market rally is over. Maybe it is, but, we're still in a good, strong uptrend. You can't just go straight up every single day. You need to kind of cool off a little bit. It looks like that's what we're doing right now. The two levels I'd be looking at really carefully, though, are the 4,100 and the 4,200. Obviously, we have a really big support at the 4,100, so a breach below that would be significant. And we do have somewhat of a resistance at 4,200. And I'd say a break above that would be significant as well. And then we can talk about levels to be watching for after that if the time comes. But I'll leave it here for today. Again, really appreciate everyone listening or watching this episode. Please subscribe on YouTube if you're in the crowd that is watching this episode. And if you're listening, please follow wherever you listen to podcasts. I'd really appreciate it. Help grow this channel. And until next time, thank you for listening, and I'll see you tomorrow.